Hello everyone, and welcome back. To understand the gravity of the situation, we must first see how the foundation cracks. Right now, we are witnessing a financial earthquake that most people remain completely oblivious to. $500 billion gone. That is the headline you need to pay attention to. Because China AES debt dump triggers a global financial warning that is flashing red for the American economy. This is not just about stock market fluctuations or routine trade deals. This is about the very bedrock of our financial system crumbling. China has systematically slashed its holdings of United States Treasury securities, draining over $600 billion from our fiscal foundation. If you care about the value of the dollar in your pocket, you need to understand why this $500 billion gone serves as the ultimate wake-up call. China has reduced its holdings from a peak of $1.32 trillion in November 2013 to just $688.7 billion in October 2025. These are the instruments that kept this nation's spending apparatus running. This occurred quietly, methodically across months and years, and most Americans remain completely unaware it even transpired. Now, I've invested substantial time examining economic transformations like this, and I need to be candid with you today. What I am about to explain transcends any political headline you have encountered this month. It transcends any social media post, any political rally, or any cable news debate. This concerns the fundamental architecture of American power and the fractures that are now evident for anyone willing to examine them. If you remain with me through this analysis, you will comprehend something that perhaps 1 in 100 people truly grasps. Why the next decade is going to feel vastly different from the last 5. Let us examine it. So, what actually transpired here? Let me provide you the straightforward version first, then we will delve deeper. China used to be the largest foreign holder of United States Treasury securities. At its apex, China held more than $1.32 trillion in these instruments. To contextualize that exceeds the entire annual economic production of nations like Mexico or Indonesia. Today, China holds less than $689 billion, having fallen to third place among foreign treasury holders behind Japan and the United Kingdom. That means China has withdrawn over $630 billion from America's debt infrastructure. More than half $1 trillion that used to finance United States government operations, military expenditures, and fiscal shortfalls has been simply removed. Now, when I reference treasury bonds, I want to ensure you understand what we are genuinely discussing. These are not abstract financial instruments. They are essentially promissory notes from the United States government. When America spends beyond what it collects in taxation, which it has done every single year for over 4 decades, it covers the deficit by issuing these bonds. Foreign nations purchase them, and for an extended period, China was the predominant purchaser of all. Consider it like a credit facility. But instead of a financial institution extending you credit, foreign governments lend you capital by acquiring your debt. And just like a credit facility, there is an assumption embedded within that someone will always be willing to lend. But what transpires when your largest creditor declares, "Actually, I am no longer interested"? That is the circumstance we are now confronting. And here is what makes this particularly consequential. China did not engage in panic selling. The data from the United States Treasury Department reveals a clear, steady pattern. China has reduced its holdings in 7 out of the first 10 months of 2025 alone. Year after year, month after month, China has been methodically diminishing its exposure to American debt. This was strategic, calculated, and it transmits a message that capitals around the world are now receiving loud and clear. But to truly comprehend why this matters and why it should matter to you personally, we need to rewind approximately 50 years and examine how the system was constructed in the first place. In 1971, President Richard Nixon made a determination that fundamentally transformed how the global economy functions. He removed the United States from the gold standard. Before that moment, dollars were backed by actual gold. If you held dollars, you could theoretically exchange them for a fixed quantity of gold held by the United States government. This created discipline. The government could not simply print unlimited currency because it had to maintain gold reserves to back up that currency. Nixon terminated that system. And what replaced it was something economists have debated ever since. Here's how it operates now. And I want you to really absorb this because it explains virtually everything about American economic power. After the gold standard ended, the dollar did not collapse. Instead, it became what is termed the global reserve currency. This means that nations around the world hold dollars as their primary savings. They utilize dollars to trade with each other. They price petroleum in dollars. They settle international transactions in dollars. Why? Because the United States had the largest, most stable economy. Because the United States military protected global shipping lanes. Because, quite simply, everyone agreed to trust the dollar. And when everyone trusts something, it becomes the standard. Now, here is where this gets intriguing. Being the world's reserve currency grants the United States an extraordinary advantage. Some economists call it an exorbitant privilege. I think that is actually an understatement. Consider what this means in practice. The United States can create dollars, literally create them, and the rest of the world will accept those dollars as payment. Every country needs dollars to conduct business internationally. They need dollars to purchase oil. They need dollars to build reserves for emergencies. So the demand for dollars is essentially integrated into the global system. This allows the United States to do something no other country can do: spend vastly more than it earns without facing immediate consequences. Examine the numbers. The United States represents less than 5% of the world's population, yet it consumes close to 25% of the world's resources. How is that mathematically possible? How can 5% of people utilize 25% of the resources? The answer is the dollar system. America runs massive trade deficits year after year. It purchases far more from the world than it sells, and normally that would be unsustainable. If you or I spent more than we earned every month, eventually our credit would be exhausted. Financial institutions would stop lending to us. We would face real fiscal consequences. But the United States has been running trade deficits for over 40 consecutive years. And the consequences never seemed to materialize. Why? Because other countries kept purchasing American debt. They kept lending to America by acquiring those Treasury bonds we discussed earlier. And the biggest lender of all was China. Here is how the cycle operated. American consumers purchased Chinese products: electronics, clothing, furniture, everything. Those dollars flowed to China. The Chinese government then took those dollars and invested them back into United States Treasury bonds. So the money made a circle. Americans bought Chinese goods, and China used the payment to fund American debt. Some economists characterize this as a mutually beneficial relationship. Both sides win. They said America gets inexpensive goods and cheap financing. China gets access to the world's largest consumer market. This brings us to the critical turning point: the weaponization and the shift. However, that description glosses over something critical: power. By holding over $1 trillion in American debt, China was deeply entangled in the United States financial system. If the United States decided to freeze those assets, to impose sanctions, to weaponize its financial infrastructure, China would be vulnerable, and for years that might have seemed like a distant theoretical concern until it was not. February 2022, Russia sends forces into Ukraine. Within days, the Western response is unprecedented, not just in military aid, but in financial warfare. The United States and its allies froze approximately $300 billion in Russian central bank reserves. Let me repeat that number so it registers. $300 billion. Frozen assets that Russia had accumulated over years, held in what they believed were secure international accounts, suddenly inaccessible. Now, whatever your perspectives on Russia or the conflict in Ukraine, step back and consider what this moment revealed to the rest of the world. It proved beyond any theoretical debate that dollar-denominated assets can be weaponized. It demonstrated that if you hold your national savings in dollars, in United States Treasury bonds, in Western financial institutions, those savings exist at the discretion of Washington. Cross certain lines and that wealth can disappear overnight. Now, position yourself in Beijing's perspective. You're holding between $700 and $800 billion in United States Treasuries. You have watched the United States designate you as its primary strategic competitor. The Pentagon openly identifies China as its top concern. Washington is building military alliances throughout Asia explicitly designed to contain Chinese influence. Trade restrictions are tightening. Technology transfers are being blocked. There is constant discussion about defending Taiwan with military force. And the entire time you're sitting on $750 billion that this same government could freeze with a single executive order. What would you do? The answer is obvious. You would reduce your exposure, you would diversify, you would find alternatives. And that is exactly what China has been doing. But here is the part most people miss. China did not just start selling bonds. It built an entirely parallel financial infrastructure, and it has been doing this for years. First, there's CIPS, the cross-border interbank payment system. This is China's alternative to SWIFT. If you do not know what SWIFT is, it is essentially the messaging network that banks use to transfer money internationally. Almost every major international transaction flows through SWIFT in some way. And critically, the United States has significant influence over SWIFT. It has used that influence to cut countries off from the global financial system. Iran, Venezuela, Russia, North Korea. With CIPS, China created a backup, a way to move money internationally without depending on systems that Washington can monitor or disable. As of January 2025, CIPS has 1,467 indirect participants across 119 countries, linking 4,800 banks in 185 countries. Second, China has been aggressively promoting the Yuan for international trade. The renminbi is reportedly already used in approximately 50% of intra-BRICS trade, though it constituted only about 2% of global payments in mid-2025. It has established currency swap agreements with dozens of countries. It is opening Yuan clearing centers in major financial hubs around the world. More and more of China's foreign trade is now invoiced in yuan rather than dollars. And third, and this is crucial, China has been accumulating gold. In November 2025, Beijing maintained its gold buying streak for the 13th consecutive month, with official data showing China's gold reserves rose to 74.12 million troy ounces, valued at $310.6 billion. Now, China does not publish precise figures on all its gold reserves, and that opacity is intentional. But every credible estimate suggests China has been one of the world's largest gold buyers for years. Thousands of tons of physical gold. Why gold? Because gold has a property that Treasury bonds lack. It cannot be frozen. It cannot be sanctioned. It cannot be printed into existence. It exists outside any government's control. If tomorrow the United States froze every Chinese dollar asset, that gold would still be there, still valuable, still useful. It is the ultimate hedge against American financial power. So when we see China selling Treasury bonds, we are not just watching a financial transaction. We are watching a country deliberately, systematically extracting itself from American financial control. Now, if China were the only country doing this, we might dismiss it as an isolated strategic move. But China is not alone, not even close. Japan, historically a major holder of United States Treasuries, increased its holdings to $1.22 trillion in October 2025, while the United Kingdom raised its holdings to $877.9 billion. However, the broader pattern shows diversification globally. Saudi Arabia, the country that essentially created the petrodollar system by agreeing in the 1970s to price oil exclusively in dollars, is now publicly discussing alternatives. Saudi officials have talked about accepting yuan for oil sales. 10 years ago, that would have been unthinkable. Central banks worldwide are buying gold at levels not seen in decades. Between 2020 and 2024, central banks of BRICS member states purchased more than 50% of global gold, systematically reducing their reliance on dollar-denominated assets. And then there's BRICS. Brazil, Russia, India, China, South Africa, and now expanded to include Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates. These countries now represent a larger share of global economic output than the G7, the traditional club of wealthy Western nations. In December 2025, BRICS launched a pilot program for the unit, a gold-backed digital settlement instrument using a 40% gold and 60% BRICS currency basket that adjusts daily. While officials from India and Brazil have stated there are no immediate plans for a unified BRICS currency that would replace the dollar, members are actively building development banks that operate outside Western control. They are establishing trade relationships that bypass the dollar entirely. Understanding this, we must now face the consequences and the road ahead. Here is another data point that rarely gets attention. According to the International Monetary Fund, the dollar's share of global reserves has declined from over 70% 2 decades ago to 59% as of 2024. That is a meaningful drop, not a collapse, but a clear trend, and each individual development reinforces the others. Argentina and Brazil now trade in their own currencies. Russia reported in 2024 that 90% of its trade within the BRICS bloc was conducted in national currencies rather than dollars. China and India have engaged in rupee-yuan trade agreements. Saudi Arabia discusses yuan-denominated oil sales. Any single one of these arrangements is small, but together they represent something significant: the gradual construction of a world that does not need the dollar quite as much as it used to. Now, defenders of the current system will push back here. They will say the dollar is too entrenched to be displaced. They will point out that there is no single alternative currency ready to assume its role. They will note that China has its own economic problems: a stressed real estate sector, an aging population, slowing growth. And those points are not wrong. The dollar is not going to lose its reserve status tomorrow. There will not be a single dramatic moment where everything changes. But that is not how these shifts happen. They happen gradually and then suddenly. For 50 years, the dollar's dominance seemed unshakable. Now, for the first time, countries have genuine alternatives. They have other places to hold reserves. They have other currencies to invoice trade. They have other payment systems to move money, and they are using them. So let us discuss what this means for the United States. Right now, the United States government runs massive budget deficits, trillions of dollars per year. Interest payments on the existing national debt now exceed $600 billion annually. That number keeps growing as interest rates rise. The United States is caught in what economists call a debt spiral. It has to borrow more each year just to cover interest on previous borrowing, on top of all regular government spending. And if the traditional foreign buyers, China, Japan, oil exporters, are reducing their purchases, someone else has to make up the difference. Who steps in when foreign demand drops? The Federal Reserve, America's central bank. When the Fed purchases government debt, there's a technical term for it: debt monetization. In plain language, it means the government is essentially creating money to fund itself. We witnessed this happen on an enormous scale during the pandemic. The Federal Reserve AS balance sheet expanded from under $4 trillion to over $9 trillion at its peak, more than $5 trillion created and used to purchase government debt. And what followed? The worst inflation in 40 years. Food prices jumped 20, 30, even 40% on some items. Gas prices surged. Rent costs climbed. Real wages, wages adjusted for inflation, actually fell for most workers because pay raises could not keep pace with rising prices. This is the hidden tax of money creation. When the government prints money to cover its deficits, it does not affect everyone equally. People who own assets, stocks, real estate businesses, see those asset values rise. People who depend on wages and savings see their purchasing power erode. So here is the bind the United States faces. If foreign buyers continue stepping back from Treasury bonds, the government has limited options. It can dramatically cut spending, which is politically almost impossible. It can raise taxes substantially, which is equally difficult. Or the Federal Reserve can keep monetizing the debt, which means more money creation, which means more inflation, which means your dollars buy less. There is no easy escape from this arithmetic. It is the accumulated consequence of decades of spending beyond our means. And let me be direct about something. This is not just about numbers on a spreadsheet. This is about power. The dollar-based system has been the foundation of American global influence for over 50 years. It funds a military presence in over 80 countries. It enables sanctions regimes that can crush foreign economies. It allows the United States to maintain a defense budget larger than the next 10 countries combined. All of that rests on the dollar's special status. And if that status weakens, even gradually, the entire structure of American power becomes more fragile. I want to bring this back to your life because I know this can feel abstract. Bond markets, reserve currencies, central bank policy, these are not things most people think about day to day. But the effects are real and they are coming. If the dollar loses purchasing power internationally, imported goods become more expensive. And in a globalized economy, almost everything has some imported component. Your phone, your car, your clothes, your food. In many cases, higher import costs mean higher prices at the register. If the government has to pay higher interest rates on its debt, there is less money available for everything else. That means pressure on education funding, infrastructure, healthcare programs, Social Security. The choices become painful: either cut services or borrow even more, which makes the debt problem worse. If we enter a period of sustained inflation, the kind that erodes savings and makes planning impossible, household financial security becomes much harder to maintain. Retirement becomes less certain. Everyday expenses eat into what you can save, and if the global economy fractures into competing currency blocks, supply chains become less reliable. We have already seen glimpses of this during the pandemic. Shortages, delays, price spikes. A more fragmented world means more of those disruptions. I'm not trying to frighten you. I'm trying to prepare you. The world that many of us grew up in, where American economic dominance was simply assumed, where the dollar was unquestioned, where the consequences of overspending always seemed to land somewhere in the future. That world is transitioning into something different. The transition might be slow, it might take a decade or more, but the direction is increasingly clear. So where does this go from here? I see 4 possible paths, and I want to lay them out honestly. The first path is managed decline. The United States accepts a multipolar economic world. The dollar remains important, but shares space with other currencies. This would require significant humility, a willingness to reform international institutions, to give rising powers more voice, to accept constraints on unilateral action. Based on current political dynamics, this seems unlikely. The second path is confrontation. The United States tries to force the world to maintain dollar dominance through pressure, more sanctions, more trade restrictions, more explicit use of financial power as a weapon. President Trump has explicitly threatened 100% tariffs on BRICS members contemplating alternative currencies and de-dollarization. This is dangerous because it turns economic competition into geopolitical conflict, but it is not implausible. History shows that declining powers often reach for coercion when persuasion stops working. The third path is crisis. The current trajectory continues until something breaks: a failed Treasury auction, a spike in interest rates, a currency crisis. This would be the hard landing scenario. Financial markets freeze, the economy contracts sharply, and then the adjustment happens all at once rather than gradually. Every year without meaningful reform makes this more possible. The fourth path, and I think this is the most likely, is fragmentation. The global system gradually splits into currency zones: a dollar zone centered on the United States and close allies, a Yuan zone centered on China and its trading partners. Perhaps regional arrangements in other parts of the world. No single dramatic collapse, but a slow erosion of the unified system that existed before. None of these outcomes are certain. The future has not been written yet. But what I can tell you is that the assumptions of the past 50 years, the assumptions that America's financial position was unassailable, those assumptions are no longer safe. But to fully grasp the magnitude of what is coming, we need to look beyond the immediate headlines and understand the historical cycle we are trapped in, along with the technological revolution that makes this shift different from anything we have seen before. This brings me to a critical realization that most financial analysts are afraid to voice. We are not just witnessing a market correction, we are witnessing the end of a long-term debt cycle. History is littered with the corpses of currencies that once ruled the world. In the 17th century, the Dutch guilder was the world's reserve currency. It seemed invincible until it collapsed under the weight of excessive debt and war. Then came the British pound sterling. For over a century, the phrase, safe as the Bank of England, was the global standard for financial security. But then, 2 world wars and massive debt accumulation eroded that trust. The tipping point came in 1956 during the Suez crisis. When Britain tried to assert its military power in Egypt, the United States threatened to sell off its massive holdings of sterling bonds. That threat alone forced Britain to retreat. It was the moment the world realized the pound was no longer the king. It was a vassal to the dollar. The irony should not be lost on anyone today. We weaponized our financial dominance against the British in 1956, and now the rest of the world is building systems to ensure we cannot do the same to them. The difference this time is that the challengers are not just using better diplomacy, they are using better technology. And this is the part of the story that should keep every American awake at night. We are entering the age of Central Bank Digital Currencies, or CBDCs. China is light years ahead with its digital Yuan. This is not just credit card money. This is programmable, state-controlled currency that operates on an entirely different rail than the traditional banking system. When you swipe a Visa card, the transaction bounces through a dozen intermediaries, most of which touch the American banking system. That gives Washington the power to see, stop, or freeze that money. But with the digital yuan and projects like mBridge, which connects the central banks of China, Thailand, the United Arab Emirates, and Hong Kong directly, those intermediaries are gone. They are building a digital highway that completely bypasses the United States toll booth. Think about what that means for the efficacy of American sanctions. If a Chinese company wants to buy oil from the United Arab Emirates, they can settle that trade instantly, in seconds, on a blockchain ledger that the United States Treasury cannot monitor and cannot block. If the dollar is no longer needed for the most valuable commodity trades in the world, the demand for dollars plummets. And when demand plummets, value follows. This brings the crisis right to your kitchen table, specifically to your retirement planning. For the last 40 years, the standard advice for every American over 35 has been the 60-40 portfolio. 60% stocks, 40% bonds. The idea was that bonds are the safe anchor. When stocks go down, bonds usually hold their value or go up. But that logic relies on a low inflation, high trust world. If China and other nations stop buying our debt, bond yields must rise to attract new buyers. When yields rise, the value of existing bonds crashes. We saw a glimpse of this in 2022, which was the worst year for the 60-40 portfolio in nearly a century. If we enter a structural bear market for US Treasuries because our biggest customers are walking away, the safe portion of your 401k becomes a danger zone. You might be looking at a future where both stocks and bonds lose value simultaneously in real terms, eaten away by inflation and higher interest rates. This is not a temporary dip. This is a repricing of the American retirement dream. Furthermore, we must consider the psychological component of this shift. Money, at its core, is a confidence game. It works because we all agree it has value. But confidence is fragile. It takes decades to build and moments to shatter. When you see nations like Malaysia, Brazil, and even France completing trades in Yuan, they are voting with their wallets against the dollar. They are signaling that they no longer trust the United States to be the neutral custodian of the global financial system. And once that trust is gone, it is mathematically impossible to get it back without a massive, painful reset. We are living through that reset right now. It is slow, grinding, and often boring until the moment it becomes catastrophic. So, when you look at your financial future, do not just look at the S&P 500 chart. Look at the geopolitical chessboard. Understand that the cheap goods, the low interest rates, and the stable inflation of the last 30 years were dividends of the dollar's empire. As that empire retreats, those dividends disappear. You need to be prepared for a world where cash is not trash, but cash is volatile. A world where real assets, things you can touch, like real estate, gold, commodities, productive businesses, become the only true hedge against a currency that is losing its global monopoly. This is the new reality. It is uncomfortable. It is unfamiliar. But denying it will not make it go away. The only way to navigate this is to face it head on, with eyes wide open to the historical tides that are turning against us. Before I close, let me leave you with 3 key points to remember. 1. China has reduced its United States Treasury holdings from $1.32 trillion to $688.7 billion, a drop of over $630 billion, not in a panic, but through deliberate strategic rebalancing. China now ranks 3rd among foreign holders behind Japan and the United Kingdom. This signals a fundamental shift in how major powers view dollar-denominated assets. 2. The freezing of Russian reserves in 2022 changed the calculation for every country that holds dollars. It demonstrated that those holdings exist at Washington's discretion. Countries are responding by diversifying into gold, into alternative currencies, into parallel financial systems. BRICS has launched pilot programs for gold-backed settlement instruments, and China's CIPS system now links 4,800 banks in 185 countries. 3. The United States faces an impossible math problem. It needs buyers for its ever-growing debt, but the traditional buyers are stepping back. The alternatives, cutting spending, raising taxes, or printing money, all carry serious costs. There's no painless exit. What we are watching is not a crisis that will resolve next month or next year. It is a structural shift that will reshape global economics for decades. And the sooner we understand it clearly, the better we can prepare for what is coming. I would like to hear your perspective on this. Where do you think this leads? Are we witnessing the end of an era, or is this just a temporary adjustment? Drop your thoughts in the comments. I read them, and the conversations there often sharpen my own analysis. If this breakdown helped you see something you had not considered before, subscribe to the channel. I'm committed to explaining complex issues in ways that respect your intelligence without drowning you in jargon. Thanks for staying with me through this. I will see you in the next one.